The United States housing market is entering a period defined not by the typical rhythms of a normal real estate cycle, but by deeper, slower-moving forces that intersect across economics, demographics, insurance systems, migration patterns, and long-term cost structures. What unfolded between 2020 and 2022 was not merely a boom, it was an acceleration of demand that stretched nearly every system involved in residential development. Remote work loosened geographic constraints. Mortgage rates created a temporary surge of purchasing power. Investors added fuel, and migration patterns reshaped entire regions. But as the environment shifted, the underlying pressures have started to reveal themselves, and those pressures are not localized. They are statewide. The correction forming now is not an isolated slowdown. It is the first stage of a recalibration occurring across multiple states simultaneously, each affected by its own vulnerabilities. Some states are confronting structural affordability gaps. Others are absorbing the impact of insurance crises. Some face oversupply. Others face demographic stagnation. But the common thread is clear. The housing markets that expanded the fastest, stretched the furthest, or depended most heavily on external factors are the ones now showing the earliest signs of contraction. This transition did not happen abruptly. It has been building over several years. As mortgage rates climbed off historic lows, demand softened. As inflation drove operating costs higher, ownership became more difficult for average households. As insurance markets tightened, entire regions faced sudden affordability shocks. And as migration slowed from its pandemic-era highs, many state markets were left with too much supply relative to new demand. The outcome is a correction that looks less like a crash and more like a slow but steady reshaping of the national housing landscape. Florida illustrates this dynamic with clarity. The state drew hundreds of thousands of new residents over the past decade, supported by a combination of strong job growth, warm climate, and favorable tax policies. But Florida's success has collided with its structural vulnerabilities. Insurance costs have risen at a pace that outstrips wage growth and inflation. Insurers facing mounting climate-related losses have exited the market, leaving homeowners with fewer choices and drastically higher premiums. In some counties, insurance costs alone exceed typical mortgage payments. Buyers who once viewed Florida as the most accessible major migration destination now hesitate, recalculating after seeing the actual yearly expense of ownership. Builders continue constructing homes, but the absorption rate has weakened. In many regions, inventory is rising even as population growth remains positive. The pressure on Florida's housing market is not from lack of demand, but from the cumulative cost of living. Arizona represents a market shaped by environmental constraints and a changing demographic profile. The explosive growth of Phoenix and its surrounding suburbs was partly driven by remote workers relocating from higher-cost states. That wave has slowed. Simultaneously, long-term water supply concerns have reached the regulatory level. Certain counties have paused or restricted development where groundwater availability cannot be guaranteed. This uncertainty affects both current homeowners and future growth potential. Developers who once operated with confidence now approach expansion more cautiously, and buyers closely examine water policy before making decisions. Combined with rising utility expenses, Arizona's affordability advantage is no longer as strong. The market is cooling as it adjusts to these new realities. Nevada's housing market was accelerated by investor activity, tourism recovery, and migration from California. But speculative demand is fragile. As interest rates rose, investor participation declined sharply. Las Vegas, once one of the fastest-growing metros in the country, now shows rising inventory and longer time on market figures. Foreclosures, though still historically low, are increasing at the fastest rate since 2015, driven in part by adjustable-rate loans and investor withdrawals. Reno, which experienced an influx of tech workers during the pandemic, faces similar issues. The appeal of Nevada remains strong, but the market must realign with fundamentals instead of speculative enthusiasm. Texas had long been the symbol of expansive growth supported by strong employment and accessible land. But the rapid expansion across Austin, Dallas, Houston, and San Antonio pushed infrastructure to its limits, raising taxes, insurance premiums, and utility costs. Texas's affordability, once its strongest selling point, is diminishing. Austin, which surged far beyond sustainable price levels, is now seeing a broad correction. Dallas-Fort Worth shows early signs of oversupply in key suburban corridors. Houston faces a unique challenge: strong inventory levels mixed with insurance pressures related to increasing flood risk. The Texas housing market is not collapsing, but the pace of appreciation has reversed in key areas and will likely continue adjusting. Georgia demonstrates how affordability pressures can spread across a state even when economic fundamentals appear strong. Atlanta's rise created suburban expansion patterns that extended commute times, increased transportation costs, and added strain to public infrastructure. As households reassess budgets, the cumulative effect of rising insurance, taxes, and transportation expenses has cooled demand in outer ring suburbs. Even in the city, condo markets are softening despite strong job growth. Buyers are more cautious and sellers are resetting expectations. Idaho exemplifies a textbook pandemic boom and correction cycle. Boise became one of the hottest housing markets in the nation between 2020 and 2022 as out-of-state. Buyers, primarily from California, dramatically reshaped pricing. But that surge did not align with local wage structures. When external demand slowed, the market's support weakened. Inventory levels have tripled in some areas, and price declines have reached double digits. Idaho is returning to price levels more consistent with local incomes, but the process remains underway. Colorado's slowdown highlights the impact of insurance markets and cost of living trends. Wildfire risk has pushed premiums higher across several major counties. Denver, once defined by rapid growth and urban revitalization, now faces slower sales velocity and significant price reductions in several high-density neighborhoods. The tech sector, while still active, has moderated hiring. Without strong inbound migration to balance rising ownership costs, the market is adjusting downward. Washington State's housing landscape is heavily linked to the tech economy. As major employers slow hiring or shift to hybrid models, the demand for housing near job centers has softened. Properties that once received multiple offers now sit in inventory. Rising taxes and insurance costs compound the issue. The slowdown is especially pronounced in King and Snohomish counties, where price declines are accelerating. Massachusetts, long insulated by its educational and biotech industries, is now showing signs of deceleration. While its fundamentals remain stronger than many states, the combination of rising taxes, aging infrastructure, and slowing job growth is impacting buyer sentiment. High costs across nearly every category have pushed some households to reconsider relocation, and inventory is rising in once competitive markets. Michigan stands out as a state undergoing a quiet but significant transformation. Its surge during the pandemic was driven largely by affordability and remote workers seeking lower-cost markets. But without sustained job creation or strong migration, many cities now face rising listings and longer selling times. Inventory is up sharply, and several mid-sized markets show early signs of oversupply relative to demand. The housing market is adjusting, and values may continue correcting until aligned with local economic momentum. The broader narrative across all 10 states points to a central conclusion. Affordability has become the defining force in the U.S. housing market. Mortgage rates act as a catalyst, but they are not the root cause. Insurance, taxes, utilities, and maintenance have risen faster than incomes in many regions. For years, the market relied on external forces, migration, investor activity, and historically low interest rates to sustain price growth. Those forces have reversed. What remains is a system that must recalibrate to match the realities of household budgets and the economic foundations of each state. As the market corrects, the pattern is clear. States most dependent on rapid growth or external demand are adjusting the fastest. States with strong fundamentals but high costs are slowing. States with balanced conditions are stabilizing. This correction is not characterized by sudden collapse, but by steady, broad-based moderation. The United States is not facing a nationwide crisis, but it is experiencing the first synchronized, multi-state housing correction in over a decade. Understanding these shifts is essential not only for buyers and sellers, but also for policymakers and investors evaluating long-term positioning. The data indicates that pricing will continue adjusting through 2026 as markets seek equilibrium. The recalibration underway does not signal the end of the American housing dream, but it does force a redefinition of what that dream looks like and where it exists. Throughout U.S. history, the places that prospered were those aligned with the economic and demographic currents of their time. Industrial hubs thrived in the early 20th century. Suburban expansion defined the post-war era. Coastal cities surged during the rise of global trade and tech. Now, the country is entering a period where more neutral fundamentals, affordability, insurance stability, energy cost, and demographic resilience determine which states gain strength and which face decline. As these market shifts unfold, a deeper structural realignment is taking place beneath the surface. States that expanded rapidly during the pandemic must now absorb the consequences of expansion that surpassed local economic gravity. Consider the impact of mortgage rate sensitivity. In markets where prices soared far above local incomes, the shock of higher borrowing costs is far more severe. A median home that required a $500 monthly payment in 2020 now requires $3,000 or more. In states with large inflows of out-of-state buyers, pricing shifted beyond sustainable levels for long-term residents. When those inflows cool, demand normalizes at the level of local incomes, not the inflated expectations of peak years. Insurance, often overlooked during boom cycles, is now one of the most powerful forces shaping statewide markets. States exposed to wildfire, hurricane, or flood risk are seeing premiums climb at double-digit annual rates. In regions where property insurance exceeds $8,000 or $10,000 per year, ownership becomes unattainable for wide segments of the population. This is not a temporary disruption. It reflects long-term reassessment of risk by insurance carriers. When fewer providers compete, premiums rise. When risk grows, coverage shrinks. Housing markets cannot escape this reality. If the cost of staying insured grows too quickly, affordability collapses regardless of mortgage rates. Property taxes form another pillar of this statewide correction. States with fast-growing populations often relied on expanding tax bases to offset budget challenges. But when growth slows, even slightly, those states face rising fiscal pressure. Municipalities adjust taxes upward to cover infrastructure, costs, education, and public services. As taxes rise, monthly carrying costs on homes increase. In some states, property taxes now add as much to a monthly payment as mortgage insurance once did. This shift erodes demand and pushes buyers to look elsewhere. Utilities and energy costs also add friction to markets. In states with extreme temperatures, Arizona, Nevada, Texas, Colorado, electric bills have surged due to both climate conditions and higher energy prices. Cooling a home in Phoenix or Las Vegas during a record-breaking summer can cost hundreds per month. In colder states, heating costs have risen significantly. These mounting expenses reshape the perception of affordability even when home prices appear moderate. Demographics intersect with all of these factors. States with aging populations or flat migration face unique pressure because housing demand depends heavily on the behaviors of younger households. If younger residents cannot afford to buy or if they choose to migrate elsewhere, inventory accumulates faster than it can be absorbed. Michigan's situation illustrates this clearly. Its mid-sized cities enjoyed a brief lift from pandemic migration, but the underlying demographic trend, a slow-growing, aging population, resurfaced as soon as external demand eased. Without consistent inflow of younger residents, markets cannot sustain rapid appreciation. Construction patterns further influence statewide vulnerability. Between 2020 and 2023, builders across the Sun Belt operated under the assumption that demand would remain elevated indefinitely. Many states encouraged rapid development with flexible zoning and minimal regulatory constraints. This environment created short-term affordability but also led to a pipeline of housing that exceeded long-term demand. Now that the frenzy has cooled, states with heavy construction pipelines are experiencing excess inventory. Builders are reducing prices, offering concessions, and delaying new phases. Yet the inventory that already exists must still be absorbed. Investor activity is another critical force. In certain states, institutional and short-term rental investors made up as much as 25% to 35% of purchases during peak years. When rates rise or regulations tighten, these investors withdraw quickly. Their retreat leaves gaps in demand that owner-occupants cannot fill. Some markets are already seeing investors unload properties at discounts, particularly in areas where rent growth has stalled or reversed. Investor-heavy states face outsized risk when market sentiment shifts. This confluence of pressures, insurance, taxes, utilities, demographics, building pipelines, and investor withdrawal creates statewide conditions unlike the cyclical downturns of the past. Instead of isolated city-level declines, entire states are readjusting. The shape and speed of these adjustments vary, but the direction is consistent. A realignment toward affordability based on local economic fundamentals rather than pandemic-era distortions. In Florida, the insurance crisis remains the central force. Even buyers who fall in love with the location recalibrate after seeing annual premiums surpass $8,000 or more. A home that once seemed affordable now carries long-term uncertainty. As a result, more listings stay active longer, more price cuts occur, and more sellers accept concessions. The state's growth remains robust, but the cost structure now forces buyers to evaluate risk as carefully as price. Arizona's challenge is defined by environmental constraints. Long-term water access determines development potential. Builders who once planned large-scale communities now face regulatory uncertainty. Water availability is not a short-term concern, but a multi-decade shift that reshapes the perception of future value. Buyers who would have purchased confidently in 2021 now pause to examine hydrological reports, policy changes, and long-term plans. The market is still active, but no longer driven by momentum alone. Nevada confronts shifting investor behavior. During the boom years, many purchased homes as rentals or short-term listings. As demand for those rentals declines or regulatory scrutiny increases, investor enthusiasm wanes. The state's large share of investor-owned homes makes it more sensitive to rate changes. Luxury markets in Las Vegas, once insulated by strong demand, now experience price compression as buyers reassess discretionary spending in a higher-rate environment. Texas encapsulates a different set of pressures: tax burdens and infrastructure strain. The promise of affordability attracted millions, but rapid growth pushed the limits of public resources. Traffic congestion, rising utility costs, increasing insurance premiums, and elevated property taxes have altered the financial equation for homeowners. While Texas still gains population, the financial burdens reshape purchasing power. Markets like Austin correct faster due to more speculative entry, while more established metros like Dallas or Houston slow at a more measured pace. Georgia's correction is anchored in the rebalancing of a metro area that expanded outward rapidly. Suburban counties that once advertised space and affordability now face higher commute costs and less pricing power. Closer to Atlanta's core, condos and townhomes once marketed to young professionals face affordability challenges as wages stagnate. Yet Georgia's economy remains healthy, allowing for stabilization after adjustment. Idaho's decline follows the logic of supply and demand. Prices surged so rapidly during the remote work migration that they disconnected from local incomes entirely. When external demand slowed, the market had no internal base strong enough to sustain values. Boise's correction is partly psychological. Buyers no longer fear missing out, and partly structural. Inventory has risen faster than sales, forcing prices downward. The correction is not a failure, but a reversion to affordability anchored in local earnings. Colorado's pressures stem from rising risk perception. As wildfire seasons grow more intense and insurance policies adjust, many homeowners face premiums they did not anticipate. In addition, utility costs continue rising, driven by cold winters and increased grid demand. Colorado's appeal remains strong, but affordability challenges dampen momentum, especially in urban areas where prices remain elevated relative to wages. Washington State's downturn reflects the slowing of the tech sector. For decades, the state's housing demand correlated strongly with growth at major employers. When hiring slows, so does housing. As tech companies restructure or reduce office footprints, demand for urban and suburban housing decreases. Simultaneously, tax and insurance costs strain household budgets. The correction is not severe but widespread. Massachusetts grapples with an economy shifting towards slower, more incremental growth. The state's high cost of living reduces mobility, while aging infrastructure raises public expenses. Coastal insurance costs and rising energy prices add tension. Even though the state remains economically strong, buyers exhibit caution, slowing appreciation, and increasing inventory. Michigan faces structural challenges rooted in demographic trends. While certain cities thrive during the migration wave, long-term population stagnation returns as a dominant factor. Without consistent inflows of younger workers, demand softens. Housing markets dependent on pandemic-era momentum see listings stay active longer, and price cuts become more common. Michigan's correction is significant, but reflects a return to normalcy based on local economic performance. Across all 10 states, one universal trend emerges. Homebuyers are far more cautious than they were 2 or 3 years ago. They scrutinize every cost, not just the mortgage. They weigh long-term risk, not just short-term opportunity. They evaluate insurance markets. They research tax policies. They consider utility expenses. They examine ecological and economic resilience. This shift in buyer behavior reshapes demand and forces markets to reflect true affordability rather than temporary surges. The next 2 years will likely continue this pattern of readjustment. States with higher risk exposure will adjust more quickly. States with high costs but strong economies will slow but remain stable. States with balanced fundamentals will see moderate corrections followed by gradual recovery. The housing market is transitioning from a period of artificial stimulation to one grounded in long-term sustainability. This national recalibration is not a crisis, it is a return to equilibrium. It is a shift from a market defined by urgency to one defined by discernment. It is a redistribution of demand based on affordability, stability, and long-term value. For buyers, it is an opportunity to evaluate markets with clarity. For sellers, it requires realistic expectations. For investors, it demands strategic repositioning. Understanding these forces empowers buyers and homeowners to navigate the market with intelligence rather than fear. The next chapter of the American housing landscape will not be defined by limitless growth, but by sustainable alignment between economic fundamentals and market behavior. The states that adapt will thrive. The states that resist adjustment will face prolonged stagnation. The American housing market is not collapsing. It is maturing. And in that maturity lies the foundation for a more balanced, stable, and predictable future, one where prices reflect real demand, where ownership is attainable for those aligned with local economies, and where risk is acknowledged rather than ignored. This is not the end of the housing boom. It is the beginning of a more sustainable era.